Financial statement analysis basically helps you as a business be interested in the financial health of the business because these show indicators for business survival, decision making, and ultimate um, profitability. So when you're using these financial statements, you need to know the organization's past performance, present, to predict the future using trend analysis. So financial statement analysis also is very essential as a comparative tool for the financial statements within the company, which we call intra-company analysis, and amongst subsidiary companies, which we call intra-company, and also may use this knowledge to assess your performance against the industry averages. So we apply analytical tools, which we call financial statement analysis for decision making. Now, we're going to look at some ratios that are important in your course that you need to know. So we have two key factors that are involved in business survival, which is profitability and solvency. These are very key and cardinal because the investors of the company will need to know whether we're making more revenues than we are spending. So we call them the profitability ratios. They also need to know the solvency, how we are able to meet our debt obligations, because most of these companies will usually operate on debt. So financial statement analysis will give you that knowledge. So the ratios we're going to look at under ratio analysis will be 5, where what we call the liquidity ratios, profitability ratios, efficiency ratios, leverage ratios. And these ratios have the following saved purposes. Number one, if we're dealing with liquidity ratios, we're basically looking at how our firm will meet its short-term obligations. And if we're dealing with profitability ratios, we're looking at how the firm is able to gauge its profitability based on its sales and its assets. Efficiency ratios, we're looking at how well our assets are being used to generate sales, and leverage ratios, we're looking at the extent to which debt is used to finance a company. So if we're over leveraged, it means we are over borrowing. And finally, investment ratios will give us a picture of the investment on behalf of the shareholders as to how well the firm is performing. So each of these ones have sub types of ratios. Under liquidity, we have 3, the current ratio, which is simply the current assets divided by the current liabilities. By now, you should be able to understand what current assets and what current liabilities are. The quick ratio, which is simply the current assets themselves, we subtract the stock, then divide them by the current liabilities. Then we also have the cash ratio, which is simply the cash equivalent over the current liabilities. We have efficiency ratios where we have the inventory days, debtors days, creditors days, and the total asset days. The inventory days simply look at how long it takes for us to sell our stock. Too much time is a problem, too little time too is also a problem. So if we're selling too quickly, we have a stock out cost. If we're selling late, we have storage security costs. We also have what are called receivable turnover, which looks at how long it takes for our debtors to pay us, and also creditors turnover, which looks at how long we also take to pay. The total assets turnover simply looks at the contribution that the assets have on the sales. We also have leverage ratios, which simply show us how our debt to equity is in terms of ratio, how much of debt we have in our capital structure compared to the equity. The long-term debt to equity ratio just looks at the long-term debt that we have against our equity. Now we have these ratios in comparison. Then also have profitability ratios, which have the following: the gross profit margin, the net profit margin, the operating profit margin, and the return on equity with the respective formulas as has been given. Are we together so far? Any questions? So under current ratio, we have a benchmark. Remember, sometimes we need to refer to the performance. We may think we are performing well as FM, and yet the benchmark is below par. So the benchmark for the current ratio is 2:1. This means that for every 2 assets, we should have 1 liability. Of course, it may 1:1 is also okay, which is the benchmark for the asset test ratio. In the asset test ratio, we just negate the stock, because when a creditor wants to collect their monies, they will not look at the stock that you have, because they will not have time to sell or buy. So that is how we calculate that. So under profitability ratios, we must understand that in the long run, profitability and solvency become meaningless if in the long run, liquidity and solvency become meaningless if the company is not profitable. If you're not scoring, you don't show any profits, then we are not surviving as a firm. So profitability simply looks at whether we're able to earn more income than the expenses. We may have assets, yes, but we need to have a profit to run with. And so profitability ratios will look at the growth in terms of the gross profit, net profit, and the capital employed. So these are the formulas you focus on. The gross profit percentage is simply gross profit over sales times 100. Gross profit margin is simply gross profit over cost of sales times 100. And we also have net profit percentage, which is simply the net profit before the taxes over sales times 100. And the return on assets is simply the net profit over the average total assets divided by times 100. So this looks at how much money is being earned on every quarter invested in terms of assets. So here, if we have a higher return on assets, which is greater, it means that the return on assets is higher. So we also have the return on equity, which is simply given by the net profit over the average equity times 100. Now this is interesting because this ratio not only falls under the profitability ratios, it also falls under the investor ratios, because it shows the net earnings that the investors are getting from the investment in terms of equity. So the shareholders are interested in this ratio very much because it actually shows how viable the investment has been. So this is how the return on equity structure looks like. Now, we also have the asset management, which we also call efficiency ratios, which are 4. Asset management or efficiency ratios basically look at the managers themselves. Are we using the assets very well? Or are we using the assets to generate sales in a proper manner? So we have the asset turnover, which simply gives us the ratio of the efficient use of the assets to generate revenues or sales. So this ratio is as follows. If we have a smaller investment being used to generate sales, it means we are more profitable. But if we have huge sums of money that are tapped and yet we are receiving few quarters in terms of sales, then it means that our asset turnover is very low, it's declining. And we also spoke of debtors days, which looks at how long we take to receive our money. So credit sales over debtors. So these ones look at the debt collection department. If we have a lower ratio, it simply means that we have problems in the company in terms of debt collection. Creditors turnover, on the other hand, looks at our ability to pay our debt. So our lower ratio simply indicates that we're facing liquidity problems. We're taking too long to pay our creditors. These two ratios are very dependent. So when you're doing an analysis, it is not just an issue of interpreting it in terms of how the performance is in terms of the ratio. You must also interpret it in terms of the cause and effect. But because we received monies late from our very debtors, it affected our credit turnover. Stock turnover, like I mentioned, looks at the number of times we take to sell our stock within a year. It's given by the cost of goods sold over the stocks themselves. So the stock turnover is best compared to the industry rather than at the company level, so that you see if you're dealing with fast-moving goods, the average industry level. You should have choked. So it's better you use the market rate. So if you have fast-moving inventory, it means you are more efficient. So when you're making your analysis, it's very important that you analyze it in terms of the market. Then when we go to asset management, we also have what is called working capital. Working capital is simply our current assets minus the current liabilities or the total assets in short. So it looks at how well our working capital employed is being used in the business to generate sales. So all these have their own respective formulas, and you need to interpret them more than just numbers. Gearing ratio finally looks at how our company is financed. So if we have a high gearing ratio, it means we're dependent on debt capital, which is a problem. And as such, corporate managers should be worried. The lower gearing meaning you're mostly inclined to being financed by your own equity. So if your dependence is so much on equity, it means you are depending on your own resources. Of course, you must have a balance because these two groups are antagonistic. We have the managers who want to borrow, who want you to use retained earnings, and the owners of the business who want you to use external funds because they want a dividend declared. So the following, we have a debt to asset ratio, which is total debt over the assets times 100. We have debt to equity ratio, which have debt over equity times 100. And we also have the TIE, which is actually the times interest earned, which is given by the earnings before interest and tax divided by the interest. And this is one ratio that most bankers are interested in because the firm's ability to pay debts is dependent on this. Usually, if you have a TIE which is greater than 2, it means you're performing so well. The market ratios also look at investors in terms of the perception of the company at the market level. So we have what we call the dividend yield, the EPS, which is earning per share. So, and dividend per share. So if we have dividend yield is given by the gross dividend per share divided by the market price per share. Earnings per share is the net profit after tax over the number of issued ordinary shares. Dividend per share is simply the dividends divided by the number of issued ordinary shares. And dividend payout is simply the dividend per share over the earnings per share times 100. So some of these ratios are dependent on the previous answer you got. You are given all these formulas in the exam, and you are asked to analyze it using any. Sometimes you are tied, you'll be given the ratios to use, but needless to say, I'll need you to understand the key aspect of what? Interpretation. So we're going to look at this example later on when we have time. I'll send the question and the solution so that you take time based on what I have explained and how the analysis was done, where we're given the income statement and also the balance sheet and the cash flow statement. And here we're asked to make an analysis based on the benchmarks and also the internal interpretations. So we're asked to critically analyze the financial performance and write a report on behalf of the board on the position. So the calculations were done with the ratios respective of their categories, the liquidity ratios, the asset ratios, the turnover, asset turnover, the efficiency ratios and activity ratios, we went the profitability ratios. We also looked at the debt to equity ratio, and we summarized all these answers and gave a report based on the benchmark and the answer that we got. So it's an interesting analysis that you need to know. It carries 25 marks of your exam and requires you to apply in terms of the analysis that I've given you. For instance, certain times you may find that the current ratio is a bit below the ideal level, but they're all within acceptable ranges. So you give your own perception on what you think the performance is. Ultimately, you who's a non-financial accountant by profession should be able to give an indication. Take keen interest in understanding how well a business is operating based on your basic information. I usually give an example of the X-ray or an example of the full blood count. A master's level student must be able to be keen to understanding what it means if your platelets are high. What does that mean? Obviously, you know that there's a bacterial infection. If your red blood cell, so those interpretation levels should also be applied here, where you need to know, okay, why did we take long to pay back? Maybe there was a loan somewhere which was huge, which we took long to break down. Okay, why was our debtors creditors payment period long? Maybe because we took long to pay. Look at the individual constituents of these two books that I took you through. The income statement and also the balance sheet, after which you will be able to give reasonable report, which is objective based on the inputs of the two books. So ratio analysis or financial statement analysis is more than just figures, but more about how you interpret the figures based on the company and how its operations have been. So we end here. Thank you so much for your time, and I'll send this document for your review. Have a good day.